Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and I'm here with Mike to break down Alaska Airlines' 10K filing for fiscal year 2025. Mike, we're looking at a company that generated $10.43 billion in revenue with $303 million in operating income, but the raw numbers don't tell the full story. What's your take on the narrative shift here?
The narrative has unchanged because the filing lacks substantive management commentary on strategic direction, and because the risk disclosures show no material escalation from prior periods. What we're seeing is essentially a status quo filing that reinforces Alaska's existing operational framework without signaling major pivots or new constraints.
That's interesting. In an industry where we typically see dramatic narrative swings, Alaska appears to be holding steady. Let's dig into the material changes and financial pressure points. What stands out most?
The dominant pressure point is liquidity positioning relative to debt structure. Alaska is carrying $5.31 billion in long-term debt against just $627 million in cash and equivalents. That's an 8.5 to 1 ratio that creates structural constraints on capital allocation flexibility. Operationally, this debt load means Alaska must maintain consistent cash generation to service obligations while funding fleet renewal and route expansion. For investors, this represents a balance sheet that's working but not providing strategic optionality during industry downturns.
That debt-to-cash ratio is striking. How does this play into their cost structure durability?
The second pressure point is margin sensitivity embedded in their cost base. With operating income of just $303 million on over $10 billion in revenue, Alaska is running roughly 3% operating margins, extremely thin for an airline that needs to absorb fuel volatility, labor cost inflation, and aircraft lease escalations. Operationally, there's minimal buffer for external shocks, whether that's oil price spikes or demand softness in key markets. For investors, this suggests earnings will be highly sensitive to revenue per available seat mile changes and unit cost creep.
So, we're looking at a company that's operationally sound but financially constrained by both debt service and margin compression risks. What about the third pressure point?
The third element is fleet concentration risk. Though the filing doesn't provide detailed breakdown of aircraft types or lease versus owned ratios, what we can observe is that Alaska's $523 million in current debt suggests significant near-term obligations that could include aircraft financing or lease payments coming due. Operationally, any fleet concentration in specific aircraft types creates maintenance cost volatility and operational disruption risk if manufacturers face production or service issues. For investors, this represents potential earnings volatility that's difficult to hedge or predict.
Let's shift to management commentary signals. What tone are we picking up from leadership in this filing?
Here's where the filing becomes notably sparse. The extracted content shows no key management quotes from the MD&A section, which itself signals management's strategic communication approach. When airline executives choose not to provide substantive forward-looking commentary or strategic framing, it typically indicates either operational focus over growth ambitions or uncertainty about market conditions that makes bold statements risky. Operationally, this suggests Alaska is in execution mode rather than transformation mode, focusing on operational reliability over strategic pivots. For investors, the absence of management vision statements means you're buying current operational performance rather than a growth story or turnaround narrative.
That's a fascinating point about what's not said being as important as what is said. Does this management silence extend to their strategic priorities?
Exactly. The lack of extracted strategic commentary suggests Alaska's leadership is either highly confident in their current trajectory, making detailed explanations unnecessary, or they're navigating uncertainty that makes public commitments inadvisable. Given the thin operating margins we discussed, it's more likely the latter. Operationally, this means Alaska is probably focused on operational excellence and cost management rather than market share expansion or route network transformation. For investors, this creates a challenge in assessing management's capital allocation priorities and competitive positioning strategy.
Now let's examine the risk disclosures. Are we seeing new threats or escalation of existing concerns?
Risk disclosures were largely unchanged from the prior filing. This is actually significant in the current aviation environment, where most carriers are highlighting new regulatory pressures, supply chain constraints, or competitive dynamics. Alaska's stable risk profile suggests either strong risk management or a business model that's less exposed to the industry's current pressure points. Operationally, this implies Alaska has identified its key risk factors and built operational processes to manage them rather than discovering new vulnerabilities. For investors, unchanged risk disclosures provide confidence that Alaska isn't facing hidden operational challenges, but it also suggests limited upside from risk mitigation improvements.
So Alaska appears to be in a steady state risk environment. Let's dive deeper into their liquidity and balance sheet positioning. How constrained or enabled is their strategic flexibility?
The balance sheet is functioning, but not empowering strategic optionality. With $627 million in cash against $5.31 billion in long-term debt, Alaska has sufficient liquidity for normal operations, but limited firepower for opportunistic investments or competitive responses. The current debt of $523 million suggests significant near-term obligations that will consume cash flow over the next 12 months. Operationally, this means Alaska must prioritize cash generation and debt service over growth investments or market share battles that require sustained cash outflows. For investors, this balance sheet structure provides stability but caps the upside potential from strategic initiatives or market expansion opportunities.
That's a critical constraint. How does this debt structure affect their ability to weather industry volatility?
The debt-to-cash ratio creates vulnerability during demand shocks or fuel price spikes. Airlines typically need 2 to 3 months of revenue in cash to weather significant disruptions, and Alaska's $627 million provides roughly 3 weeks of coverage based on their $10.43 billion annual revenue run rate. Operationally, this means Alaska cannot afford extended periods of reduced capacity utilization or route suspensions without accessing additional credit facilities. For investors, this tight liquidity position means Alaska's stock will likely be more volatile during industry stress periods compared to carriers with stronger cash positions.
Let's move to segment analysis. Which parts of Alaska's business are driving or dragging overall performance?
The filing content doesn't provide detailed segment breakdowns, which itself tells a story about Alaska's business model focus. Unlike network carriers that report detailed hub performance or international versus domestic results, Alaska appears to operate as an integrated system without highlighting specific geographic or route type performance drivers. Operationally, this suggests Alaska views its network as interconnected rather than a collection of distinct profit centers, which can create operational efficiency, but makes it harder to identify underperforming assets. For investors, the lack of segment detail means you're investing in Alaska's entire network strategy rather than betting on specific high-performing routes or markets.
That integrated approach has both advantages and blind spots. Does this affect how we should think about their competitive positioning?
The absence of segment reporting suggests Alaska either has relatively balanced performance across its network or prefers not to highlight internal performance variations that could signal competitive vulnerabilities. Given their West Coast focus and point-to-point model, Alaska likely views route-level disclosure as competitively sensitive information. Operationally, this integrated reporting approach supports network optimization decisions, but provides less transparency into which markets generate superior returns. For investors, this means Alaska's valuation should reflect network-wide performance rather than premium valuations for specific high-margin routes or markets.
Now let's look ahead. What should investors monitor in future filings to track Alaska's trajectory?
Here are the 4 key items to watch. First, watch cash flow from operations in quarterly filings, because it will confirm or contradict whether Alaska can service its debt load while funding necessary capital expenditures. Second, watch any changes in debt maturity schedules or refinancing activity, because it will confirm or contradict management's ability to maintain current liquidity levels without diluting equity holders.
What about operational metrics?
Third, watch unit cost per available seat mile trends in quarterly MD&A sections, because it will confirm or contradict Alaska's ability to maintain margin stability in an inflationary cost environment. Fourth, watch for any management commentary changes in future filings regarding strategic priorities or market outlook, because it will confirm or contradict whether the current operational focus represents confidence or uncertainty about competitive positioning.
Those monitoring points give investors a clear framework for tracking Alaska's execution. Any final thoughts on this filing?
Alaska's 10K presents a company in operational steady state with financial constraints that limit strategic flexibility. The unchanged narrative reflects management focus on execution rather than transformation, which may be appropriate given their debt service requirements and thin operating margins. For investors, Alaska represents a bet on operational excellence within a constrained capital structure rather than a growth story or turnaround opportunity.
That wraps our analysis of Alaska Airlines fiscal 2025 10K filing. Remember, this analysis is for informational purposes only and should not be considered investment advice. I'm Sarah with Mike, and we'll see you next week on Aviation Intelligence Weekly.